Hello everyone and welcome back to Week in Markets with your investment team here at True Potential. This is a chance for us to look back on recent events in markets and hopefully provide some context for why equities and or bonds have been moving the way they have. This week we're going to focus in on the bond market. I'm delighted to be joined by Matt Henderson, my colleague from the investment team. The reason for the focus on bonds is because we've got two big political risks occurring over the next 2 weeks. We start with the UK budget here, and then of course in the first week of November we'll end with the US presidential election, and both could have profound consequences for government spending. And that's what we believe has been driving bond markets over the last couple of weeks. But we've seen some large moves in yields this week in particular. So Matt, could you help us provide some context for why we think bond yields have been rising? If we start with the UK, we can then go on to the US.
Yeah, so I think with gilts, if we think where they sort of bottomed in September and where we are now, around 50 basis points higher, so 0.5% higher than where we were at those September lows. So it's actually quite a sharp move in that period of time, as you outlined, Kevin. And really what we think it's down to is the upcoming budget, as you mentioned earlier. So as we know, we've got new government in, new chancellor, etc., and they're looking to increase the amount that they could borrow. So they're looking to, from the leaks that we're hearing from newspapers, they're looking to increase the potential amount they could borrow by about 53 billion. So what does that mean? Well, we should see more supply in gilts into the bond market. When that happens, investors usually demand a higher return. So we see yields rise when that happens. But also there's some thinking in the market that actually if this capital is used productively and invested into projects that could actually generate growth, what we might actually see is growth rates pick up, but then also the second order effect of that, which is higher inflation. So then the market actually starts to take a step back and think, actually, do the Bank of England need to do as many rate cuts as we originally expected if we start to see growth generating policies enacted?
That's actually a good point, because it's not just the UK that where we've seen these rising yields. We've seen it in the US, but of course, and it might be a subtle point, but it's worth making that we're actually seeing fewer rate cuts being priced ahead. So we've just had the Federal Reserve last month cut interest rates by a lot. The Bank of England are signalling that they're likely to cut rates again in about 3 weeks, but it may be that we just don't see as many cuts as we expect in 2025 because of the level of government spending and the support it's providing to economies.
Yeah, so I think at the minute, by year end, we're looking at about 1.5 rate cuts priced for both the UK and the US. And then into next year, as you said, markets were looking at about 10. We're now closer to 5. So
really, it's markets building up what we would describe as a risk premium, which is there's still some unknowns, but we do know with some certainty that we're going to get a bigger supply of gilts in the next few years, and most of that the Chancellor is committed to being for capital spending. So bond markets are just pricing that they want to be able to receive a higher yield for that additional supply of gilts. So if we contextualise that, Matt, just with today's data regarding the PMI, so these activity surveys for the UK, I mean, what's noted for me is that we've had the lowest reading for services in the UK since November last year. So perhaps this is the platform now for the Chancellor to try and boost growth by investing more in capital infrastructure.
Yeah, absolutely. So as you mentioned, the PMI data gives us a feel of how the economy is performing, and with that reading being below 50 signals contraction. So as you're saying, it might be a reason for them to look to spend this additional funding that they're looking to raise to try and boost growth, given some of the underlying weakness that we're just starting to see come through in the UK data.
I mean, there's a seasonality in this, which is typically these surveys some of it reflects optimism, which is that it's based on businesses' opinions of the future, and typically that's seasonal, so that tends to peak in around mid-spring to early summer. So what we're looking at ahead is we know energy prices are going up with the energy price cap reset, so perhaps people's spending powers will be somewhat crimped going into the end of the year. So it's good from that perspective that the Chancellor is looking at what can boost growth, and of course investing in the future is exactly that. So there's no reason to be worried about that, but there are a number of other spending commitments the Chancellor has made. In the FT yesterday, for example, the Chancellor is committed effectively to ending austerity. So that implies higher spending in most government departments, and that's possibly where markets are maybe somewhat worried about a surprise next week. So let's Matt, let's take it on to phenomenon we've witnessed in the past, which is markets tend to overprice, over-worry about a risk event. We discussed this earlier. A great example would be 2016, wouldn't it? So if we begin with the EU referendum here in the UK and what the market thought was going to be the outcome going into that.
So typically markets will price for what the outcome they believe is going to happen. And as you mentioned, at the Brexit referendum, the probability was that Remain would happen. So actually when the vote announcement comes through and it's actually the vote is to leave, on the day you see a snap reaction to unprice what had effectively been priced in.
So the markets went in thinking growth would be okay.
Yeah.
So, but what happened was the shock was growth would fall. So we saw lower bond yields pricing lower growth. We saw lower stock prices in the UK, again pricing lower growth. But then we had an event later that year in 2016, which was the US presidential election. And the consensus going into that was?
That was not for Trump to win.
Yes, so it would be President Hillary Clinton. So the reaction after was the opposite of what we had in the UK. So we had higher bond yields, higher stock prices globally because markets were pricing pro-growth Trump, which was more fiscal spending, lower taxes. So we had markets basically were whipsawed, two major risk events. And what the consensus clearly here now in the UK is that the market is expecting a lot more borrowing, so a bigger supply of gilts, perhaps room for further surprises in gilt supply in future budgets. So again, the conversation we've been having as investment team today is market is probably fully priced the worst that could come from Chancellor Reeves, maybe by the start of next week. And
I think one of the things we can also expect, because as you mentioned, we've got the budget, the US election coming up, markets don't like uncertainty, so that can usually cause volatility. So I guess one of the conversations as well we've been having around the desk is just to expect higher equity volatility over the period until those outcomes are known by the market, and then the market can start pricing what it believes the future will look like.
And this is again that point that it's not just in the UK we're seeing higher bond yields, we're seeing them higher in the US. The likelihood of President Trump winning has increased in the betting markets, and bond yields have moved effectively up with that in tandem. So then we've got this sort of twilight zone after the budget, before the US election, where all of the risk has probably come out of the event in the UK, but global bond markets will probably still reflect some volatility ahead of the US presidential election in just under 2 weeks now.
And that's a similar story to what we've seen in the UK, where if Trump wins, they're expecting more fiscal spending and more issuance of US bonds. So it's a similar theme that we're seeing in the US.
And you talked about uncertainty. Some of the views around the US election is that on the day we won't know the result. It may take up to the rest of the week for us to know. And of course, it's not just a presidential election, it's the elections in Congress. So if, for instance, President Trump is elected, but there's a Democrat-controlled House, then that may actually be quite good for the bond markets, because that House is likely to not pass a Trump budget. So there's a number of events which could worry markets either side of the election, and this period just happens to be unusual that we've got two events so close together, and bond markets are beginning to price that.
But it probably brings in the importance of being diversified, and just allowing the portfolio to, by having different assets that react differently, to then bring down the overall risk.
And that's, I guess, in bond markets. We're seeing that in Europe, which is clearly slowing growth. We're seeing a similar budget in France. So what's being proposed in the UK, which is higher taxes to fund a bit more spending, that's coming through to some extent in France, but that's leading the European Central Bank there to forecast more interest rate cuts because the growth impulse across Europe is quite low. Germany, for example, has had no growth for the last 4 quarters, so a very different growth backdrop there. So in summary, what we've tried to convey today is that bond markets are reflecting the uncertainty about near-term risk events, the UK first, the US presidential election. It won't all be solved by the time we speak with you next week, because of course we'll be facing the US presidential election. But this is typically the way markets work, that when they have known risk events, they tend to overprice the consensus. So we may actually see bond yields in the UK fall after the budget, because all of the bad news will have been in the price. But that's all for today. So please do join us next week, where we'll be able to cover off the UK budget and then reflect on market moves ahead of the US presidential election. Please do like and subscribe on the YouTube channel, and please do continue to tune in to Morning Markets, as we'll update you on US inflation data over next week. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.